Investment fees and how they can be draining your retirement savings. So let's get some expert advice now from a fund analyst, David O'Leary of Kind Wealth. Good to see you, David.
Yeah, good to be here. Thanks, Greg.
So here's something. There's a fee associated with everything in life, but sometimes we're not aware of how these fees could be impacting the money that we're putting away and trying to grow for retirement. So what do we need to be aware of?
Yeah, well, you said it really well. For most Canadians, the biggest expense that they are paying that they have no idea they are paying is for their financial advice and for their investments. And those two things, the advice and the investment kind of management, all get bundled together into one big fee. For most Canadians, that's through fees through their mutual funds. And that fee kind of averages 2 to 2.5% of the investment that they have in those mutual funds.
That's the thing. When you start looking at perhaps some of the returns you get from certain years, some years are better than others, you think, 2, 2.5, 3 doesn't sound like a lot of money. But if you're only getting a return of maybe 7% on average, you're starting to talk about some money going out the door.
Yeah, it's a very big amount, and it's fixed, right? It doesn't fluctuate with the ups and downs of the market, and it quietly compounds. And the biggest problem is, again, people just aren't aware that this amount, it'd be one thing if you're paying that amount and you know what you're receiving in exchange for it, and you deem that to be of good value, and you're happy to pay that fee. But most people I speak with have no idea they're paying anything, never mind how much that bill is.
Now, we did have those new rules come in, the CRM, so I always have to look, I always forget, I hate acronyms, CRM2, but this was supposed to make the game clearer for us, that we were supposed to understand as investors what was going on and where the money was moving and how much was going out. Has it achieved that, do you think?
No, I do think that it has had a meaningful impact in terms of it's creating questions in the minds of investors, because the statements they received for the first time in history actually were required to have the dollar value of some of the fees they were paying, not all of them, the fees specifically for the advice they were getting, in dollars and cents on their statement. And that's prompted people to start asking questions in a way they hadn't before. But there's still, I think, that's a meaningful percentage, but it's still the minority of people. I think most people still don't know they're paying their fees because it's still buried and it's in some disclosure and statements they're not opening and reading.
Now, of course, in the industry, they refer to it as management expense ratios. And when you're talking about mutual funds, you're saying you can see 2 to 3%. You start getting into the ETF space, and if it's one of those ETFs that are just tied to the overall market, like the S&P 500 or the TSX 60, those management expense ratios can come down dramatically. What do investors need to know about that? Is it more than just that story? If they say, oh, look at that, 15 basis points, I'm moving all my money there. What do they need to be aware of?
Yeah, I would say it's not quite as simple as, well, it's cheaper and so it's just definitely better. But on average, for most people, they're going to do better by taking an ETF that has a passive approach. So as you mentioned, it's just tied to a benchmark. And you're cutting your fees dramatically because you're not paying a whole team of professionals to try to beat the market. They're just trying to match the market. And that's much easier to do, and you can lower your costs. And on average, those tend to do better than a lot of active money managers and mutual funds. And so most people, I think, would just be better off that way, especially because it removes a lot of the decision making around which actively managed fund should I choose? Is it Fidelity? Is it RBC? Is it TD? So with ETFs, you still have a little bit of that, but the difference between a good performing passive ETF and a poor performing one is a much narrower range. So if you get it wrong, you're not sacrificing as much. If you get it wrong when you're picking an active fund manager, you're paying not only much higher fees, but they could be really out of sync with the market and do poorly.
Now, when it comes to that challenge, I guess, to the mutual fund industry from ETFs, we've heard in recent years that, well, the mutual fund industry will react by lowering its fees. Have you seen significant lowering of those management expense ratios, like enough to make it worth to stick with the mutual fund industry?
Nowhere near enough to make it kind of worth it for most people to stick with actively managed mutual funds. I think there are, that's a blanket statement. There are some diamonds in the rough, but the trouble is for most people is, how do you find those diamonds in the rough? How do you separate the wheat from the chaff? Most people just don't have the time, energy, inclination, knowledge to do that. So no, they haven't come down enough for it to really make mutual funds on aggregate more attractive or competitive with passive products.
Now, if you're in what I would call an enviable position of having a sizable amount of money to put to work in the market, does that give you, as the investor, as the person saving for retirement, a little bit of power, a little bit of leverage with the person who's handling your money, saying, listen, I've parked a lot of cash with you. I think we can bring these fees down.
Yeah, definitely. So that's that's both a benefit for people who have those types of assets. It's a problem for a lot of Canadians the majority of Canadians who don't have that type of bargaining power. But those who do, you still just have to be very conscious that you have that power, and then you have to negotiate hard for it, compare competition and sort of compare offerings so that you really get that down. I've seen a lot of cases where wealthy individuals are still paying way above what they should be or could be if they knew properly what they should be getting it for.
Do you find overall, though, people just sort of think, it's complicated, I just put it all over there, I don't want to think about it. And obviously that does not work for you in the long term.
Yeah, and there's a lot of, my advisor, John, he's my buddy, he wouldn't do this to me, and there's a very collegial and friendly relationship with your advisor you may have been dealing with for decades, and there's a lot of trust built up, and John's not trying to do anything nefarious, but, he's gotten used to an industry, or she's gotten used to an industry where fees have been high, and it's normal for them, and so they don't think much of it. Meanwhile, they should be a lot lower.
Okay, fascinating stuff. Thanks for joining us, David.
Thanks for having me.
Great advice. Fund analyst David O'Leary from Kind.